This is TechCrunch. Robinhood announced Monday it has filed an application with the U.S. Securities and Exchange Commission to launch a new publicly traded fund that will hold shares of startups. The idea behind the Robinhood Ventures Fund is to allow every retail investor access to make money on the hottest startups before they go public. While the current version of the application is public, Robinhood has not filled in the fine print yet. This means we don't know how many shares it plans to sell, nor other details like the management fee it plans to charge. It is also unclear which startups it hopes this fund will eventually hold. The paperwork says it expects to invest in aerospace and defense, AI, fintech, robotics, as well as software for consumers and enterprises. Robinhood's big pitch is that retail investors are being left out of the gains that are amassed by startup investors like VCs. That's true to an extent. Accredited investors, or those with a net worth large enough to handle riskier investments, already have a variety of ways of buying equity in startups, such as with venture firms like our crowd. Retail investors that are not rich enough to be accredited have more limited options. There are funds similar to what Robinhood has proposed, including Cathie Wood's ARK Venture Fund, a mutual fund which holds stakes in companies like Anthropic, Databricks, OpenAI, SpaceX, and others. Robinhood's last such effort was controversial. The trading company launched what it called private tokenized stocks in the EU earlier this year, implying those tokens gave retail investors the ability to make money from shares of private companies like OpenAI. However, OpenAI denounced the product, pointing out that buyers of these tokens were not actually buying OpenAI stock, tokenized or otherwise. They were simply buying tokens pegged to prices of a private company's stock. This new closed-end ventures fund is a more classic mutual fund style approach. As to when Robinhood's new fund would be available, well, we don't know that either yet. Robinhood, which is in a quiet period, declined to comment. Rodatherm Energy, a new geothermal startup, emerged from stealth Monday with $38 million in funding and a plan to build a pilot in Utah. The startup differentiates itself by plumbing its boreholes with a closed loop, likely made of steel, that's filled with a refrigerant. Now, that contrasts with other enhanced geothermal companies which tend to use water to transport heat from deep within the earth. The Series A round was led by Evoc Innovations with participation from Active Impact Investments, Giga Investments, Grantham Foundation for the Protection of the Environment, MCJ, TDK Ventures, Tech Energy Ventures, and Toyota Ventures. Rodatherm faces stiff competition with an established field of players, including Fervo Energy, Sage Geosystems, XGS Energy, and Quaise. Fervo is considered the frontrunner in the space, having raised nearly $1 billion. The company is on track to complete a 100-megawatt first phase of its Cape Station power plant next year, with an additional 400 megawatts coming online in 2028. It also has a deal to supply Google with electricity for its data centers. XGS Energy also has a data center deal, one with Meta, to develop a 150-megawatt power plant in New Mexico to power the tech company's data centers. Rodatherm says that its closed-loop refrigerant-based approach is 50% more efficient than a typical water-based system. Air source heat pumps, commonly called mini-splits, use hydrocarbon-based refrigerants to shift heat between indoors and out. The startup's patent on the technology says that the closed-loop design will eliminate the need for filters to screen grit and debris that open-loop systems might suck up as the water flowing through the ground breaks bits of rocks loose. It also says that the closed-loop system will minimize water use. But Rodatherm's approach will almost certainly come with increased drilling and installation costs relative to simpler systems. Now, it is possible that the added efficiency of its refrigerant based design could offset those costs, though that remains an open question until the company completes a well. The company plans to use the Series A funding to complete a small 1.8 megawatt pilot plant in Utah by the end of next year. Utah Associated Municipal Power Systems plans to buy electricity from the project. Amid an ongoing surge in defense tech investing, advanced manufacturing company Divergent Technologies raised $290 million to expand production of missile parts and other specialized components for the military. The round, which values the company at $2.3 billion, was first reported by Bloomberg. Divergent's customers include major defense primes Lockheed Martin, RTX, and General Dynamics. The new capital, of which $40 million is debt, will help the company expand its manufacturing facilities in Los Angeles and to break ground on a new factory in Oklahoma next year. Divergent's specialized 3D printers make up to 600 parts, and CEO and co-founder Lucas Zinger told Bloomberg that metal missile airframes are the company's bread and butter. The raise underscores investor appetite for startups boosting America's domestic manufacturing capabilities as weapons demand continues to strain traditional supply chains. That's it from TechCrunch. For more tech stories like these, go to TechCrunch.com.